We circle back to our top story this morning. President Trump signing an executive order modifying tariffs on dozens of countries with levies ranging from 10 to 41%.
The White House has released a list of nations that will be receiving adjusted levies, including 19% for Malaysia, Cambodia, and Thailand.
Tariffs on Singapore remain at the baseline 10%. Levies on Canadian goods have been raised to 35% from 25%. Countries not on the modified list will get a baseline 10% levy.
Now, the Trump administration promised 90 deals in 90 days, but since April 2nd, the so-called Liberation Day, only a handful of frameworks have been announced. Now, these include agreements with Japan, Vietnam, Indonesia, the Philippines, the EU, UK, and a tariff truce with China. South Korea is among the buzzer beaters, managing to seal a deal to set the tariff rate at 15%. It's lower than the 25% President Trump threatened, but still higher than what Korean negotiators lobbied for. In exchange, Seoul pledged hundreds of billions of dollars in investments and U.S. energy purchases.
The European Union put an end to a months-long standoff between two of the world's largest trading partners as Commission President Ursula von der Leyen struck a deal with Mr. Trump. The U.S. is set to impose a 15% duty on imports from the bloc, halved from what was earlier threatened. Now, the pact bears similarities with the Japan agreement, which President Trump also hailed as perhaps the largest deal ever made. America's fifth largest trading partner haggled for months to lower tariffs to 15% from 25%. Levies on the powerhouse automotive sector were also cut to 15% in exchange for pledges to buy American rice and more than $500 billion in investments. Vietnam, too, promised greater access to American firms to have tariffs slashed to 20% from 46%. But the U.S. has accused manufacturers of routing their goods through Vietnam to dodge steep duties on Chinese products, a trade trend called transshipment. So now Washington isn't taking any chances and is charging 40% tariffs on transshipments, particularly those originating from China. Indonesia agreed to remove almost all tariffs for the U.S. to lower its rate on Indonesian goods by 13 percentage points to 19%. Jakarta also offered to purchase 50 Boeing aircraft and import billions of dollars worth of energy and agricultural products from the United States. But President Trump sees a major win in securing U.S. access to Indonesia's rich mineral reserves, including those critical to AI development, space, and defense. The Philippine deal is patterned after Indonesia's tariffs were lowered 1 percentage point, while Mr. Trump claimed Manila would open its market to the U.S. with zero tariffs. The UK was the first to secure a deal with the U.S., getting the baseline 10% levy on most goods. It was able to reduce tariffs on cars and aerospace exports, but is still pressing the U.S. for some relief for its critical steel industry. So analysts say all these deals are far from final. There's some countries trying to lower the rate even further and seek more clarity on how tariffs would be implemented. Questions also remain on what's next in the tariff truce between economic giants, US and China. White House negotiators recently said President Trump has yet to greenlight plans to extend a 90-day truce that would significantly cut tit-for-tat tariffs that had earlier reached triple digits. Now, that tariff truce set to expire on August 12th. Key sticking points, though, loom large, including rare earth minerals, allegations of unfair Chinese trade practices, and fentanyl control measures.
For more now, we are joined by Robert Koopman, Hurst Senior Professorial Lecturer at American University's School of International Service. He is also the former chief economist and director of economic research and statistics at the World Trade Organization. Professor, thank you very much for coming on the program today. I want to start with China. You have said in the past that consumers in China, they save a lot, that the country has worked really hard to diversify its trade portfolio. So what's at stake for Beijing now? And how do you expect talks to unfold during this final stretch?
Yeah, well, I think the challenge with China is going to be that as you pointed out, and I've said before, they've already diversified their trading partners quite a bit. So they're nowhere near as reliant on the U.S. market as they used to be. The challenge for the United States is that they have critical minerals that the U.S. is very interested in for a number of economic and national security issues, right? Both defense, but also potentially green transition and AI-related technology products. So that deal is taking a while to work out. And I want to emphasize here that you talk about these things as deals rather than agreements, because typically in trade agreements, you see a lot of details written down, a lot of very specifics, tariff line, tariff changes, very specific language about regulatory and SPS related issues. You might see some things around investment. We've seen very little details on this. And I think what we're seeing are deals that allow the President of the United States to declare victory. At the same time, the trading partners are basically deciding not to retaliate, which gets them the relatively lower tariff than what was threatened. That means that they don't lose as much as they would have if they retaliated and the U.S. put higher tariffs on. But we have a lot of constructive ambiguity in this language where both sides of the deal basically get to say, we got something out of this, and it's yet to be determined exactly what it is. And as time passes, we'll both interpret the language in the deal in a way that favors us, which likely means more negotiations, more discussions, and more uncertainty for trading firms.
Okay, Professor, with all that in mind, I want to take us to some of the latest developments. The big one, obviously, is that extension for Mexico, another 90 days. So I'm wondering whether or not, this is, a selective outlier simply because it's, the top trading partner for the United States. And could this possibly apply to China again, which is what some people are saying? There will be another extension for China. Or could it possibly mean, maybe a broader, longer extension for everyone so that more deals and more negotiations can take place?
So I think what's interesting about China and Mexico is that lots of U.S. multinationals have significant supply chain positioning in both of those countries. And I think President Trump is hearing from a lot of domestic firms that these are very disruptive negotiations, they're very costly. In many cases, what I hear from these private sector actors is what they want is certainty. They want to know what is the deal. It's not clear that the administration knows what the deal is that they want. But those multinationals with significant business operations or economic relations with Mexico and China, I think, are causing the president and his trade negotiators to think very hard exactly about what kind of deal we can come up with. And it's also very important to realize that the USMCA agreement, the former NAFTA agreement, is up for renegotiation overall. So the president is using his leverage here. He's using his leverage rather assertively. We'll have to see what happens with this legal case that's working through the U.S. system. But he has other levers that he can use. But I think they're slowing this down and trying to work out the specifics of these two large trading partners that are very intertwined with U.S. multinationals, particularly those with domestic sales, but also those with international sales. I think it's giving them pause, and it's giving both sides trying to think about what is a reasonable solution here.
Right.
And I do want to emphasize that even a reasonable solution for the trading partners is likely a costly one for U.S. multinationals. So they're going to incur higher costs. Their supply chain costs are going to go up.
I hear you, Professor. I do want to ask you about, the possible reaction from financial markets. We saw the bond market basically forcing his hand previously. Have investors come to terms? I mean, we're not seeing too much of a reaction, but do you think that could change?
So I've done some work that suggests that the microeconomic costs of the Trump tariffs and around the amounts that we're seeing here, it was hard to know exactly which ones to pick, but they're around the amounts that we're seeing here. The microeconomic costs of those tariff distortions are relatively small, anywhere from about 0.5 to 0.8% of GDP growth. And if you're growing at 2.8%, that means you're only growing at about 2%. And by the way, we're starting to see those kinds of things coming through in the economic data. But the macro side is the really big story. So I think the US economy can absorb these microeconomic tariff shocks. It'll raise prices once. It's not inflationary in terms of the prices of the goods. It's a one-time increase if those tariffs stay pretty stable. There could be factor market, labor and capital market prices that go up as a result of trying to build more factories in the United States. But I do think, back to your financial market question, financial markets are basically trying to decide where's the best place in the world to invest. And despite the Trump tariffs at this point, they still feel that the US market, with its innovation, its tech firms, is still a relatively good place to invest. There's a downside coming, and that is, will people continue to buy Treasury bonds? What happens if consumer sentiment and consumer spending weakens? We already see that stabilizing, and we see investment weakening pretty significantly. Those are the kinds of things that at some point investors are going to say, hey, wait a second, there will be some real effects here. Maybe there's better places to put our money. And there's the dollar side, which is the Treasury bond market, right? That is pretty concerning. You mentioned that one. That seems to have stabilized a bit. But then there's the portfolio investment, the foreign direct investment. That side we've seen kind of stagnate, but not go away. And so I think we have to wait here. Anybody who predicted that the impacts of the tariffs would be immediate really hasn't worked on trade policy for a long time. The other thing we have to keep in mind is that China's doing a stimulus. Germany's doing a stimulus. It's building out defense. So we do see, and the US had the one big beautiful bill that also provides a stimulus before some of the cuts hit. So often those kinds of fiscal policy things can more than offset the tariff policy changes. So it's a complicated situation. I don't track stock markets as a way to indicate what is happening to the underlying economic financial health of the United States. Even though many people think that it is a leading indicator, it is one indicator, but it can be driven by many other factors.
Professor, President Trump, he says the tariffs are making America great again, making America rich again. How would you assess that claim? I mean, some argue the uncertainty around the tariffs has hurt more than the levies will help.
I tend to agree with that argument. I think the uncertainty is really bad. That's why we see relatively weak investment. I think consumers are concerned, and they haven't cut spending yet, but they also haven't been increasing their spending. We see the labor market potentially softening. So I do think that the Trump administration gets wonderful headlines out of this, and that's really important to them. It's particularly important to the president. I got a deal. Look at this. I used my leverage and I got a deal. But the reality of this is that it is a tax on consumption, on imported goods and import competing goods. We already see goods produced in the United States that are protected by the tariffs. They're raising their prices. I don't think those price rises from those tariffs are the big concern. I think the big concern is that foreign investors and domestic investors are basically going to say the U.S. is now a self-centered economy. It used to be an economy that was very globally focused. Now it's one that's self-centered. The U.S. market, it's a large market, but it's small compared to global markets. If you're Boeing, and by the way, the president's very happy that firms are committing to buying Boeing aircraft, right? Are they buying Caterpillar? Are they buying John Deere? Are they going to allow our tech firms to have access to those markets? Our services is where we've had significant comparative advantage. What we have is essentially a smaller market, a rich one, but a smaller one that's going to have higher costs.
Understood.
Which means that we'll be less competitive in the global economy.
Okay. Professor, we're up against a hard break, so we'll have to leave it there. Thank you so much for your time. Appreciate it very much. Robert Koopman is Hurst Senior Professorial Lecturer at the American University's School of International Service.